this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week, as usual, we'll discuss 4 key focus points, highlighting key learnings from the market activities from the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, and point number 3, and point number 4, we'll focus on bonds. And in point number 2, we'll start with bond market volatility. Point number 3, we'll talk about bonds or fixed income performance. And in point number 4, we'll talk about sources of bond yield. So with that, let's hop right in. And now on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected negative 2.5% growth as of April 24th, which is further down from last week's negative 2.2%. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims rose by 7,000 claims, ending at 222,000, while continuing claims fell to 1.841 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement in both the 30-year and 15-year mortgage rates. The 30-year and 15-year mortgage rates ended at 6.81% and 5.94%, respectively. Now, I've updated the chart on your screen to reflect mortgage rates meeting existing home sale prices and sale prices for new homes. This set of data provides additional context to our affordability discussion. Currently, the U.S. existing home sales median price was approximately $404,000, and new home sales were also $404,000 in April. This is the first time in a long time we're seeing new and existing home prices around the same level. As we've discussed last week, new homes have been discounted on an average of 5%, and we're seeing that play out in the data here. Next, we'll look at investor sentiment. One component of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread fell slightly from a negative 31.40% last week to a negative 33.6% this week. Investors are continuing to feel quite bearish with the current market. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price-to-action relationship to the S&P 500. We've seen this in real time with the market volatility over the past few weeks. Now remember, VIX values above 30 are typically linked to large volatility, resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 24.84. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 10.4% probability of a 0.25% decrease and an 89.6% probability of no decrease in May. We continue to see this probability of a May rate cut decrease week to week. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 7.12%, a much needed win. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was also positive 6.38%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the U.S., was also positive 2.12%. The biggest mover this week was growth in income stocks, a much needed win for these equities. Now, during this week, we saw markets move based on what Scott Bessent and Donald Trump shared in meetings and on their social media pages. Now, we saw markets also reacting to earnings reports. And these earnings report movements, which is normal movement, especially while we're waiting for the final ruling on tariffs, is important to continue to watch. So during this week, we had 119 companies that reported earnings, and this is of the S&P 500. Of the 170 companies that have reported so far, which is approximately 34% of the S&P 500, and those 170 companies that have reported, what I mean by that is in this quarter, overall, 77% are beating estimates, and those that are beating estimates are beating by a margin of by a median of 5%. All really good news. Of the 23% that are missing estimates, those are missing an estimate by a median of 3%. Once again, all very good news. So remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. Just like in the stock market, greater uncertainty has led to swings in the bond market. These moves, driven by tariffs and a dispute between the White House and the Fed, have pushed interest rates and bond yields higher. While short-term volatility can often lead to unexpected results, it's important to remember that periods like this occur periodically, even if the causes are different each time. For bond investors, especially for those who rely on their portfolios for income, the current environment may present both challenges and opportunities for their financial plans. So let's take a moment and talk a little bit more about the bond market and specifically volatility in the bond market next. One of the key principles of portfolio diversification is the idea that stocks and bonds are typically uncorrelated. That is, when stocks move in one way or move up, bonds tend to move the other way, move down. Now, this is not by accident. Stocks tend to perform well when the economy is strong, whereas bonds have historically performed well during periods of economic uncertainty. This is why combining stocks, bonds, and other assets can result in a portfolio that is more stable than holding a single asset class alone, improving the odds of achieving your financial goals. So, what is happening in the bond market and why does it matter? There are periods of financial market volatility that can create exceptions to these historical patterns for short periods. For instance, bond volatility can occur when markets adjust to significant economic or policy changes, such as the ones taking place today around tariffs and the independence for Fed policymaking. When it comes to tariffs, bond investors are weighing two possibilities, conflicting scenarios specifically. Trade wars could raise prices, which could be inflationary, which is usually negative for bonds, and or they might slow economic growth, which could be positive for bonds. In addition, liquidity concerns is a possible flight from U.S. assets and technical factors that have contributed to recent moves. The U.S. dollar has also declined alongside bonds, which is atypical since higher bond yields typically attract foreign investors. The accompanying chart shows that bond market volatility has been heightened not only in the recent weeks, but also over the past 3 years. While these might be the events surrounding bond market moves, they all boil down to greater policy uncertainty. Bond prices are highly dependent not only on where interest rates and the economy are headed, but also on how uncertain this path might be. Just as recent government moves around trade have made it harder for households and businesses to plan for the future, so too is it harder to forecast where the economic variables might be in the next few months, let alone the next year. This includes the direction of the Fed policy, which is exacerbated by the headlines surrounding President Trump and Fed Chair Jerome Powell. Thus, it's not surprising that bond prices have fluctuated alongside stocks. Next, on to point number 3, bond or fixed income performance. Now, even with the most recent volatility and the volatility that we've seen over the past couple months, bonds have still helped to stabilize portfolios this year. Of course, some perspective is needed. The 10-year Treasury yield is currently around 4.3%, which is well within its range over the past 2 years. In general, interest rates are higher than many investors expected at the start of this year. Despite this, most bond sectors are still showing positive year-to-date returns, including the U.S. Aggregate Bond Index, Treasuries, and investment-grade corporate bonds. High yield, which is highly correlated with the stock market, is only slightly negative. As demonstrated by these returns, corporate bond investors are differentiating between higher and lower quality issuers and as economic uncertainty persists. Corporate bond spreads, which show how much yield these bonds generate versus treasuries, are the way to measure this. Investment grade spreads have remained fairly tight, while high yield spreads have widened considerably. Still, spreads are significantly narrower than during previous crises such as 2008, 2020, and 2022. Municipal bonds have also faced greater volatility in recent weeks. The muni ratio, which compares municipal bond yields to treasury yields, jumped off on the tariff announcement and remained elevated. The higher ratio means that munis are more attractive today compared to treasuries, particularly for investors in high tax brackets and in high tax states. Now into point number 4, sources of bond yield. Now, regardless of how bond prices move in the coming weeks, bond yields still remain attractive compared to the past 2 decades, creating opportunities across the bond market for those who need portfolio income. Investment-grade corporate bonds, for instance, currently have an average yield of 5.2% compared to the average of 3.8% since 2009. The case for bonds may also be favorable since the Fed is expected to cut rates again later this year, regardless of how the dispute with the White House plays out. For income-focused investors, current yields are attractive across many fixed income sectors and can help support portfolios amid ongoing uncertainty. So the key takeaway for all of our listeners is that policy headlines continue to rattle the financial markets. While bonds have been volatile in recent weeks, attractive yields and still healthy returns can help long-term investors achieve their financial goals. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you once again for joining and watching. We look forward to seeing you next week.